So just to give a background about Quest Investment Advisors, we started our operations way back in 1987. And from 1987 to 2007, the firm was involved into doing equity research on the mid and small cap side. We used to provide the research inputs for the domestic mutual funds, insurance companies, and also FIs when they opened up in the country. In 2007 is where we started our first PMS operations. And I'm happy to say that, out of the 400 plus PMS managers who are operating in the country today, Quest happens to be one of those few entities who has a 15-year plus track record of managing money on the PMS platform. As of today, we manage around 1400 plus HNI and corporate investors spread across an AUM of around 2100 crores. The investment team comprises of Mr. Ajay Seth and Mr. Bharat Seth. Both of them have been the founders of Quest and have been there with the firm since inception. The other two members on the investment committee, so one is Saurabh Patwa, who's our head of research. He also brings on the table a vast amount of experience. Prior to joining Quest, he was with HDFC Mutual Fund for almost 13 years. And I am there as the Chief Investment Officer and Portfolio Manager at Quest. I have been with Quest since Feb of 2020, and before coming to Quest, I was with IIFL AMC for a long time. I spent around 11 years with IIFL, and in my last role, I was managing the IIFL Multicap PMS, which I had launched in December of 14 and was managing it from December 14 up to December of 19. So we have 4 people on the investment committee, and we are supported by a team of 4 to 5 analysts. So collectively, you can say we are an 8 to 9 member team on the investment and the research, and we decide on all the portfolio construct, companies, interactions with managements, and that is the way the team works. So now talking about the Quest Alpha Opportunities PMS, I would say the differentiating factor of this PMS compared to the other PMSs which you would have come across is inbuilt in the philosophy and strategy which we adopt in constructing this portfolio. I would say that we have some USPs which really differentiates us from the rest. The first and foremost USP or philosophy of our portfolio is blending the value and the growth style of investing. I'm sure you would have heard that there are different strategies. One follows the value style, one follows the growth style. I would say that there is no right style, no wrong style. Different market cycles, it rewards either growth or the value companies. In our portfolio, you will find a blend of both. You will find both value and growth stocks even within the same sector. This brings me to the fact that in the Alpha Opportunities PMS, what we try to do is we try to have 2 parts. One is the core part of the portfolio and one is the satellite part of the portfolio. Typically, the core part of the portfolio will comprise of companies which we are comfortable holding for the medium to long term, and these will typically form you can say the ones wherein we have a consistent earnings growth of anywhere between 15 to 20%. The satellite part of the portfolio will be more of a tactical approach wherein we typically want to look for companies which might not be in flavor right now or would have had a past wherein people would be or investors would be wanting to avoid that sector and company because of XYZ reasons. And that gives us entry into that company at a very good attractive valuations when we are able to identify the inflection points of that particular company or sector. Typically, these are the tactical, I would say, companies which we would be entering into. Some of the tactical companies might move into the core part of the portfolio over a period of time. Now, this is where I say that you'll find a blend of both value and growth style in our portfolio, because typically we would like to enter into companies which are in the value part of the market, but we try to ride the whole, I would say, the multiple expansion cycle, the earnings cycle of those companies wherein they migrate from being the value to the growth part of the market. The second major USP for us is following the sector rotation philosophy. And that is something which I would say is a very, very unique differentiating style for us. Sector rotation, as is evident from the name itself, is all about being there in the right sector at the right time. It's easy to say, but I would say the idea is to enter into sectors when the earning cycles are picking up. The whole idea of sector rotation is to ride the business cycle, which leads to the earnings cycle, which leads to the valuation cycle. Typically, you'll find sectors which are, I would say, at the bottom of the cycle. They would be out of flavor. Earning cycles are not very great, and that is the time you'll find the multiples also very attractive. When the inflection points are identified, you will find that the sector goes through a massive, massive earnings upcycle and a multiple expansion. That is what we try to ride in a sector rotation of thought process. Now, if you look at over the years, definitely different sectors have gone through the good times and bad times. But if I talk about our sector rotation in our portfolio in specific, over the last 6 quarters, if you analyze our portfolio, you will find that there has been a visible shift of sectors over this last 6 to 7 quarters. If I go back 18 months back, you will find that we were overweight on sectors like pharma and chemicals, we were overweight on IT, we were overweight on the metal sector. Sectors where we were underweight on consumption, we were underweight on banks and financials, we were underweight on the whole industrial cycle. If you compare that portfolio of 18 months back with our current portfolio, you will find there has been a shift from anything to do with exports to more of domestic orientation. So what you find in our current portfolio is focus on the top 3 allocations or top 3 sectors. One being domestic consumption and autos. I would put consumption and autos into one bucket. Second would be financials, wherein you will find both the banks, private banks, PSU banks, and NBFCs. And the third would be industrials, which I would say forms the biggest chunk in our portfolio. And within industrials, I'll put defense, cement, capital goods, all of them in that bucket. So these 3 sectors, I would say, make up the bulk of the portfolio at this point of time. And we were underweight on all of these almost 6 quarters back. And as you can see in our presentation, the ones which are highlighted in green are the sectors where our weightages have gone up. The ones in red are where our weightages has gone down over this period. The next major part of our strategy is moving between the market caps, and we are very, very I would say flexible with regard to our biasness towards the large cap, mid cap and small cap. Again, if you look at our portfolio, you will find over the last 6 to 7 quarters, there has been a visible shift from being biased towards the mid and small cap almost 18 months back to getting overweight on the large caps. And 4-5 months back, we have done the reverse again, wherein we have started decreasing our allocations towards large caps and moving back into the mid and small cap. So this shift of market cap is again something which is visible in our portfolio. The third major USP for our portfolio, and that I would say is a very, very important thing to highlight, and for you as an investor, very important to know, is that the overlap of our portfolio companies with any of the top 5-6 well-known multi-cap strategies is extremely, extremely less. And that I would say adds a lot of value to your overall equity allocation, because if we had ended up buying the same stocks which is there in the other top 5, 6, 7 multi-cap strategies, we are actually not adding any value to your overall equity allocation. And that I would say is a very major important differentiation for our portfolio strategy, which is a product, which is I would say the underlying portfolio differentiation. And lastly, I would say the major USP again for us is being active style, wherein we do not hesitate to book profits. And when I say active, it should not be taken that we are the short-term traders. We typically hold companies for many, many years. But yes, we do not hesitate to book profit when we believe the valuations are looking expensive. Also, we do not mind keeping a higher level of cash in our portfolio, and taking active cash calls from time to time is also something which differentiates us from the peers. On an average, I would say we keep anywhere between 6 to 8% cash at any points of time. There have been times wherein we would have gone up to even 14-15% cash, wherein maybe the market headwinds were very strong and valuations were rich, and we found it a better opportunity to keep cash to use that when the markets are weak. So these are the broad, I would say, the portfolio philosophy and strategy around which I will say the Quest Alpha Opportunities PMS is constructed around. With regard to the portfolio performance, if you look at the performance of how the whole thought process of sector rotation, market cap rotation, active style of balancing between the market caps and also balancing both value and growth style has worked, I can say happily that over the last 8.5 years since I've been managing money on the PMS platform, there has been roughly around 8 to 10% kind of an annualized outperformance over the benchmark over this period. Definitely, it has not been in one linear fashion, but yes, on an annualized basis over the last 8.5 years, that type of alpha creation has happened by following this philosophy.